If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. China economy Q2, Mines to Brics, Ton Nan Sign. High unemployment paints a complex image of a major economy wrestling with labor market stress amid weak demand, structural disruption, and cautious policy responses. In order to frame the discussion, it is necessary to place unemployment at the center, while still referencing broader macro indicators, GDP growth, interest rate, inflation, debt to GDP, to understand the constraints and feedbacks that influence China's ability to address its joblessness. In 2024, China's official GDP annual growth was reported at about 5%, as the government pursued a target of around 5% for that year. As of early 2025, growth momentum has weakened. Some forecasts suggest China's 2025 full-year growth will slow to about 4.7%. In Q1 2025, GDP growth was estimated at 5.1% year-on-year. For Q2, forecasts suggest growth may moderate further toward 4.7%, reflecting weaker domestic demand, export headwinds, and ongoing property sector weakness. Thus, while growth remains positive, the deceleration pressures create an uneasy backdrop in which high unemployment becomes more salient. Turning to the unemployment rate, China's urban surveyed unemployment has become a focal point in 2025. By August, it edged up to 5.3%, its highest reading in several months, highlighting the fragility of job creation amid slowing economic momentum. Underlying this is youth unemployment. In February 2025, the rate for ages 16-24, excluding students, surged to 16.9%. Meanwhile, the jobless rate for 25-29-year-olds rose to 7.3%, underscoring that high unemployment is not solely a youth problem. This high unemployment must be understood against several structural headwinds. The property sector contraction continues to drag on construction and related employment as developers scale back projects. Exports are also under stress due to global demand weakness, leading to job cuts in manufacturing. And domestically, consumption remains weak as households moderate spending amid income anxiety. The result is a failure of demand to generate enough jobs to offset losses in these hard-hit sectors. Interest rates and credit policy are also part of the story. China's lending rates have been gradually eased, but the full cycle of loosening has not broken through structural risk perceptions. Credit stimulus thus has uneven transmission, limiting how effectively it can translate into new hiring. Inflation dynamics also matter. In 2025, China has slipped into mild disinflation. As of August, the CPI inflation rate declined to 0.40%. This price deflation disincentivizes business investment and hiring, as firms delay expansion in expectation of lower future revenue, reinforcing high unemployment. On the fiscal side, China's debt picture is complex. While official government debt to GDP is around 88%, the augmented debt burden, including local government financing vehicles, may approach 124% of GDP. This large debt burden limits the scope for aggressive fiscal stimulus to create jobs. Putting these indicators together, the picture is one of moderating growth, rising unemployment, constrained interest rates, negative inflation, and a high debt-to-GDP ratio. The labor market experience embodies these disparities. Regions heavily exposed to real estate or export manufacturing have likely recorded sharper job losses. By contrast, service sectors would absorb some labor, but not enough to offset deficits in manufacturing and construction. Younger graduates entering the job market have intensified these pressures as the economy's absorption capacity is stretched. Policy responses have been cautious. The government deployed selective fiscal measures like subsidies and public works, but avoided sweeping stimulus, fearful of debt escalation. In conclusion, high unemployment is symptomatic of structural constraints. The property sector drag, global trade weakening, consumption shortfall, deflationary pressures, and fiscal limits all combine to limit labor absorption. The quarter's performance highlights that growth without employment is not sustainable, and China faces a pivotal challenge in reconciling macro expansion with inclusive labor absorption. High unemployment in Q2 must be understood against structural headwinds. The property sector contraction continues to drag on construction and related employment. Many local governments and real estate developers have scaled back projects or entered defaults, disrupting jobs in construction, manufacturing of building materials, and upstream industries. Exports are also under stress due to global demand weakness, leading to job cuts in manufacturing, especially in export-dependent provinces. Meanwhile, consumption domestically remains weak as households moderate spending amid income anxiety and deflationary pressure. The result is a failure of demand to generate enough labor absorption to offset employment losses in hard-hit sectors. Younger graduates entering the job market in Q2 intensified unemployment pressures. As new university graduates enter the labor force, the absorption capacity of the economy is stretched. The 16 to 24 unemployment metric at 16.9% underscores that even in a productive quarter, youth joblessness remains an acute drag. Interest rates and credit policy are part of the environment in which high unemployment emerged. China's effective lending rate and policy interest settings have been gradually eased to support credit flows, but constraints remain. The benchmark lending rate, one-year loan prime rate, LPR, has seen cuts in recent periods, but the full cycle of loosening has not broken through structural risk perceptions, giving an ambivalent tone to financing. The real interest rate, i.e., after inflation, remains constrained by weak nominal inflation. Credit stimulus and monetary accommodation thus bear uneven transmission, limiting how effectively lending support can translate into new hiring. On the fiscal and debt side, China's debt picture is complex. However, the augmented debt burden, including local government financing vehicles, LGFVs, and off-balance sheet liabilities, may far exceed that, perhaps approaching 124% of GDP or more in aggregate. Local government debt, contingent liabilities, and implicit obligations weigh on national and subnational budgets, tying up fiscal space. High unemployment thus coincides with a large debt burden, limiting the scope for aggressive fiscal stimulus to create jobs. Putting these indicators together, the picture in Q2 is one of growth moderating, from 0.5% toward 4.7%, unemployment rising above 5% in urban surveys, interest rates eased but constrained, inflation negative or near zero, and a debt-to-GDP ratio near 88% or more when full liabilities are considered. The interplay of these forces helps explain why China may struggle to generate enough employment in Q2 despite continued positive output. Looking beyond Q2, the outlook is mixed. If growth stays near 4.7%, the economy may limp along, but not generate robust new jobs. If consumption picks up through stimulus or confidence, the employment impact could moderate joblessness over time. Youth unemployment, however, requires targeted programs for retraining, entrepreneurship, and public sector insertion. Debt risks remain a brake on big stimulus pushes. Monitoring additional indicators, credit impulse, fiscal capacity, regional disparities will be critical to assess whether high unemployment becomes entrenched. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.